1 week ago, this portfolio closed at $115,200. Today, it's worth $122,700. That's a gain of about $7,500, roughly 6.5%, in 1 week. It was a strong week. But the gain didn't come from a broad recovery across AI stocks. Most of it came from Microsoft's strong earnings and a rebound in software positions like ServiceNow. Meanwhile, the most speculative parts of the AI infrastructure trade had just suffered a brutal collapse. Then, near the end of the week, semiconductor stocks finally started to bounce. But one green day after a crash like that doesn't prove anything. So I'm watching for confirmation. Before this video ends, I'll show you the 2 AI infrastructure stocks I'm watching next week and exactly what I need to see before putting more real money into either one of them. Welcome back to Precision Capital. This is the public record of every investment decision I make as I try to turn $100,000 into $1 million. Every trade is documented before the outcome is known. Let's start with what happened inside the portfolio. My top performers this week were Microsoft, Amazon, Chipotle, and ServiceNow. Microsoft finished the week with a position value of $25,800. It gained $4,400, about 21%, this week. My total return on Microsoft is now $4,600, or 22%. Microsoft reported strong earnings. More importantly, the results gave investors more evidence that its massive AI spending is actually producing real cloud growth and real revenue. That's why Microsoft got rewarded. ServiceNow also rebounded strongly. That matters because software was the main source of pain inside my portfolio last week. This week, Microsoft and ServiceNow became 2 of my strongest performers. That doesn't prove the entire software sector has turned a corner, but it does show why I didn't abandon those positions during the weakness. But the portfolio wasn't all green. My top losers this week were Meta, Constellation Energy, and NVIDIA. Meta finished the week with a position value of $8,300. It lost about $800, almost 9% this week. My total return on Meta is now negative $500, or about negative 5.7%. Meta still reported strong revenue growth, but the company is also spending heavily on AI infrastructure, and the market wants clearer evidence those investments will eventually pay off. Microsoft and Meta are both major AI investors, but one got rewarded and the other got punished. That tells me investors are becoming more selective. And outside my portfolio, that selectivity turned into outright panic. The most speculative and over-leveraged parts of the AI infrastructure trade suffered a violent unwind. Leopold Aschenbrenner's AI-focused hedge fund, Situational Awareness, reportedly lost around 67% in July after its leveraged AI positions moved against it. The fund then had to sell off a large chunk of its public stock portfolio. At the same time, South Korea's market cracked after Samsung and SK Hynix had grown to represent more than half the weighting of the entire Kospi index. When those 2 stocks fell, that concentration, combined with leverage, made the decline far more severe. In plain English, too many investors were crowded into the same trades, and a lot of them were using borrowed money. When prices started falling, some of them didn't have the option to wait. They were forced to sell. That created a flood of urgent sell orders and pushed prices down even faster. Then, near the end of the week, semiconductor and AI-related stocks began to rebound sharply. The question was whether that rebound marked the start of a real reversal or just temporary relief after the panic. And that uncertainty is exactly what shaped the two trades I made this week. This week, I closed two profitable options trades. The first was my Microsoft put credit spread. I opened the position on July 7th for a $640 credit. On Thursday, July 30th, I closed it for a $32 debit. That locked in a profit of $608. The spread did not expire until August 21, but there was only $32 of potential profit left. That was not enough reward for me to keep the position open for another 21 days. So I removed the remaining risk and moved on. My second trade was on SOXL. On Wednesday, July 29th, I sold the $65 put for a $470 credit. The next day, I bought it back for a $170 debit. That gave me a $300 profit in one day. I entered because semiconductor stocks were showing signs of market capitulation. But this was never designed to be a long-term position. It was a quick in, quick out trade intended to capture a possible relief rally. The Microsoft decision was straightforward. Most of the available profit had already been captured. The SOXL decision required more judgment because I entered while semiconductor stocks were still under heavy pressure. So what exactly is market capitulation? And why did it make me willing to trade the rebound? Before I explain, remember that I post every trade on my community tab as I make it. So if you want to follow these decisions in real time, make sure you subscribe and check the community tab. Okay, let's look at what I actually saw in SOXL. Quick context first. SOXL is a 3x leveraged fund tracking semiconductor stocks. That leverage matters here because my play wasn't just about price. I was selling options. And when SOXL sells off, implied volatility spikes harder than it would on an unleveraged fund. That spike in volatility was exactly what made the trade attractive to me. The same fear that was scaring everyone else out of the stock was inflating the premium I was collecting. But to understand why I was willing to make a bullish trade into that panic, you need to understand what was actually happening on the chart. In theory, market capitulation happens when fear becomes so intense that investors stop caring about the price they receive. They just want out. But knowing the definition doesn't help you catch it in real time. I want to show you what capitulation can look like on a real chart and how to recognize the warning signs while it is happening. So first, look at the final weekly candle. SOXL fell sharply during the week, but the decline also came with a major increase in trading volume. That tells us this was not ordinary selling. A huge number of shares were changing hands while investors rushed toward the exit. At the same time, Williams %R dropped below -80, showing that selling momentum had reached an extremely oversold level. Now look at the long lower wick on the final candle. SOXL traded much lower during the week, but buyers stepped in and pushed the price well above its lowest point before the week ended. Heavy volume showed intense selling. The oversold reading showed that momentum had become stretched, and the lower wick showed that buyers were beginning to reject the lowest prices. None of those signals alone proves that the bottom is in. But when they appear together after a violent decline, they can suggest that the most aggressive sellers are becoming exhausted. And once that urgent selling begins to fade, it does not take a massive amount of buying to push prices higher. Even modest buying can create a sharp relief rally. That was the opportunity I saw in SOXL. But capitulation does not guarantee a permanent bottom. Sometimes it ends the decline. Other times, it creates only a temporary rebound before the selling resumes. That was why I treated SOXL as a short-term trade rather than a long-term investment. I wanted to capture the rebound without assuming the market had already formed a permanent bottom. That's why I used a short-term options trade instead of immediately adding a new long-term stock position. And as you see above, that trade returned 64% profit in just one day. Now you know why I did the short-term trade. But now we need to answer a different question. Did that rebound actually change the larger semiconductor trend? To answer that, let's switch to SOXL on the daily time frame. You can see this red line. That's the support level. Support here and here. And last week, price broke below that support, but reversed right back above it almost immediately. That created what? Yes, correct. It's a bear trap. And a bear trap like this can be an early signal of trend reversal. But to me, that's not enough on its own. I'm more conservative than that. I want to see the reversal actually confirm before I commit new capital. So, did semiconductor capitulation create a confirmed long-term buying opportunity? My answer? Not yet. It created the short-term relief rally I was looking for. But I still need SOXL to confirm that buyers have taken control before I add more long-term capital. If that confirmation arrives next week, 2 stocks will move from my watch list to possible buying opportunities. Next week, I may put new capital into 2 AI infrastructure stocks, but for 2 very different reasons. The first is Broadcom. I already own about 1/3 of the position I eventually want. If SOXL confirms its reversal and Broadcom still offers a controlled entry, I will add another 1/3. The second is Arista Networks. I do not own it yet, and earnings are coming next week. I need to see strong results, confident guidance, and a reasonable entry before I start a position. So next week, one of 3 things will happen. I add to Broadcom, I buy Arista for the first time, or I keep my capital on the sidelines. In the next episode, I'll show you exactly which decision I made and why. Every trade is posted to the Community tab before the outcome is known. Subscribe if you would like to follow the journey to $1 million in real time. I make the decisions. The market writes the ending.